Hello, this is Rob Carrig with Carrig Wealth Advisors. Today is Tuesday, April 4th, 2023, as I record this. Thanks for taking a little time as I'd like to revisit stocks and bonds, historical returns, and volatility associated with each of them. I think it's helpful given the difficult year we all went through last year in 2022, but also given the volatile but very positive quarter that just ended in 2023. Okay, first slide I'm going to go through here is, obviously there's a ton on this. I'm just going to walk through this. So this is with the S&P 500 or stocks over a long period of time from 1980 to 2022. So over 42 years, the average return was 8.7%. All of this is according to FactSet, S&P 500, S&P, and JP Morgan Asset Management. Average return of 8.7% plus dividends. So we got to add in dividends. So when you include dividends, that return is over 10% per year, which is obviously a great long-term return. Now, what is the price that investors pay for that type of return? It's clearly the volatility or the sort of variability of those returns. You can see up here that in those 43 years, 32 of the 43 were positive. Obviously, that means about 1 out of 4 were negative. The top or the gray bars are what the S&P 500 returned on any given year. Again, mostly positive returns, but there are periods of negative returns. 2008 was down 38%. Last year was down about 19%. Now, the red numbers are how bad things were at its worst in that given year. So for example, last year, the S&P finished down about 19% for the year, but at its low, it was down 25% for the year. In 2020, the first year of COVID, the S&P was down as much as 34% at its low, but finished up 16% for the year. Now, this first quarter of 2023, the S&P finished up 7%, pretty good quarter. At its worst, though, it was down 8%. So obviously, volatility isn't fun. It's nothing new. And it is, as I said, sort of the price you pay to get these longer term returns, at least historically. So that's with stocks. I'm going to take a look at the same chart, but with bonds. Here, we're looking at a source of Bloomberg, FactSet, and JP Morgan. And this is long-term returns on bonds, Bloomberg US Aggregate Bond Index. As you can see, much less volatility here. You know, from 1976 to 2022, the average return was 6.6%, a little bit less than stocks, but way less volatility. 42 out of 47 years, bonds were up. And most of the time, in the years where they're down, it's, you know, down 3, down 1, down 2. Last year, the bond index was down 13%. By many sources, that's the worst return for bonds of all time. At its worst, bonds were down as much as 17%. This is all because of the Federal Reserve raising interest rates at a rate we haven't seen in about 50 years. That's the bad news. The good news is, so far this year in the first quarter, the bond index was up 3%, which is a pretty good quarter, but at its worst was down 4%. So why am I talking about this? I think it's a good reminder for all of us that stocks are long-term investments. And to be a successful investor in stocks, we need to be focused on the long term and accepting of the volatility that goes along with it. Last year was a very good reminder that bonds can also be volatile and are really ideally suited for long-term portfolios as well. Now, one of the things that has changed in the last year or so with the Fed raising interest rates as quickly as they have is that we can now get returns in things like CDs, certificate of deposits, and treasuries of in the neighborhood of 4 to 5%. we've had more and more of our clients reaching out and wanting to sort of dial back their risk, now knowing that we can get these types of returns with a portion of their money. I call that sort of plan B. There hasn't been a plan B in quite some time. So I would encourage you all to revisit your time horizon, your risk profile. And if you feel like you would like to dial back your risk and take advantage of some of these interest rates, we look forward to hearing from you. Thank you very much.